Are you a real estate investor tired of getting denied by conventional bank limits, but not desperate enough to pay the massive fees of a hard money loan? There is a secret middle ground that is helping investors scale massive rental portfolios, and it's called a DSCR loan. If you want to build real wealth in real estate, you need this tool in your tool belt. The rate structure is another important aspect to understand about DSCR loans, especially if you are exploring a structure beyond the overwhelmingly standard fixed rate option, which is simply an unchanging interest rate for the life of the loan and representative of the vast majority, estimated to be more than 95% of DSCR loans. Loan structures that are floating rate, or when the interest rate changes from month to month or year to year during the life of the loan, are common in commercial real estate, business financing, and in residential financing in the pre-QM era of the early 2000s, but are now pretty much non-existent for DSCR loans. This change has been instrumental in de-risking loans for smaller real estate investors, many of which ran into trouble in the prior era by taking on loans with exotic floating rate structures they didn't understand well and were burnt by rapid fluctuations that led to bankruptcies or other credit trouble. While not offering a floating rate option for DSCR loans takes away some tools for investors, it provides large benefits in making the loan product durable and sustainable with conservative rate structures and offers a large group of potential real estate investors to access much needed capital to build wealth. For advanced borrowers, however, a hybrid fixed to ARM option has emerged as a potential choice. This option combines fixed and floating rate structures to balance protections against rate spikes with the ability to take on some additional floating rate risk to achieve more optimized loan terms. This structure is a hybrid, where the loan starts out with a fixed rate for several of the first years of the term, then switches to a floating structure, albeit with some limits after a certain milestone, typically after 5 or 7 years of payments are made. The date where the loan changes from fixed rate to floating rate is usually lined up with the prepayment penalty duration, so that the fixed rate period is the same as the period there would be fees due with an early prepayment. This is helpful for borrowers so that if rates move higher during the fixed rate period of the loan term and the loan's interest rate increases when the floating rate period begins, they are able to refinance a property without worrying about any prepayment penalty fees. Hybrid fixed to ARM loan structures, unfortunately, are usually expressed by lenders and even loan officers or licensed mortgage brokers in a confusing fashion. Many regrettably don't have a great understanding of these more advanced financial debt concepts themselves. This can lead to poor outcomes where borrowers are misinformed in the structure or never hear about this option in the first place. Luckily, this video will go through each provision and what they need step by step next, so you can be a well-armed borrower understanding exactly how these hybrid loan structures work. DSCR loans have a hybrid fixed to ARM structure are typically expressed in shorthand as two numbers separated by a slash mark, such as 5/6 ARM or 7/1 ARM. One important thing to remember and understand is that these are still 30-year loan terms, even though the number 30 isn't typically referenced in this representation or when lending professionals talk about these in shorthand. The first number represents the initial years of the term. Again, still always at least 30 years when the rate is fixed, while the second number refers to the frequency of rate adjustments after the fixed rate period. As if that's already not confusing enough, the second number can actually refer to either years or months depending on the context. Generally, if you see a 6 as in the 5/6 ARM example, that means after the first 5 years of the loan, the interest rate floats every 6 months. But if you see a 1, like in the 7/1 ARM example, the interest rate floats every 1 year. Confusing or poorly structured industry standard terminology in shorthand like this is another reason why it's of the utmost importance to make sure you really understand and verify the nuances of the loan rate structure. Time for an FAQ break. What is a 5/6 ARM DSCR loan? A 5/6 ARM DSCR loan is an adjustable rate mortgage where the interest rate is fixed for the first 5 years and adjusts every 6 months based on an index. These are commonly offered by DSCR lenders to provide lower initial rates than 30-year fixed options. After the fixed period, your rate and payment may rise or fall depending on market rates and loan terms. There are several additional important provisions of hybrid fixed to ARM DSCR loan structures beyond the floating rate period and the floating rate frequency. The next important concept to understand is how exactly the interest rate is calculated once it enters the floating period. The interest rate during the floating rate portion of the term is calculated as margin plus floating rate index. The margin represents a fixed percentage that is set for the life of the floating rate period. Without diving too deep into heavy real estate finance topics, this amount will generally be equivalent to a risk premium between general DSCR loans and so-called risk-free treasury bonds. In 2026, the typical margin for hybrid fixed to ARM DSCR loans is generally between 4 to 6%. The floating rate index is an index number representing the rate banks can earn from borrowing short-term overnight, similar to the Federal Reserve funding rate. In 2025, with the phase-out of LIBOR generally completed, most DSCR loans have a floating rate index equal to the SOFR, or secured overnight financing rate. To compute the floating rate on a DSCR loan that has a hybrid fixed-to-ARM structure and has entered into its floating rate period, you simply add the two numbers together. For example, if the margin is 4% and the SOFR on the interest rate change date is 3.31%, the new rate is 7.31%. However, it is not quite as simple as this. Told you understanding the structure was complicated, as there are additional provisions that also come into play when determining the floating rate. By the way, if you want to see exactly what rate you qualify for right now, check out the link in our description to access our 10-minute web application. For hybrid fixed-to-ARM DSCR loans that enter a floating rate period, there are limits to how high and how low the interest rate can go. Here are some additional provisions that are included on these types of rate structures. Limit number 1, floating rate ceiling. The interest rate when the loan is in its floating rate period is equal to the sum of the margin and the floating rate index. However, there is a limit or ceiling to how high the rate can go. Typically, DSCR loans under this structure have a floating rate ceiling that are 5 to 6% higher than the initial interest rate. Take, for example, a hybrid fixed-to-ARM DSCR loan with an initial interest rate of 7% and a ceiling 6% higher than the initial rate, a typical ceiling structure. In this example, the interest rate during the entire term of the loan would never be able to exceed 13%, even if the sum of the margin and floating rate index was higher than that. This ceiling structure helps provide certainty for borrowers so that even if rates increase significantly, there is a limit to how high the monthly payment on the loan will ever go. Limit number 2, floating rate floor. The interest rate floor is similar to the ceiling, but the reverse. The floor is a percentage that the rate can never go below, in contrast to the ceiling, which is a percentage that the rate can never go above. Typically, on DSCR loans that have the hybrid fixed-to-ARM structure, the floor will be equivalent to the initial fixed interest rate, so even if market rates decrease by the time the floating rate period kicks in, the rate will never go below the initially charged rate. Limit number 3, floating rate periodic adjustment cap. This number represents the maximum percentage the interest rate can change in an instance of a change in floating rate, typically every 6 or 12 months once the initial fixed rate period finishes. For DSCR loans with a hybrid fixed-to-ARM structure, the floating rate periodic adjustment cap is typically 1%. This generally means that in case the floating rate index changes by more than 1% between floating rate change dates, it will be limited at just a 1% change regardless. For example, if there's a DSCR loan that is in a floating rate period that floats annually with a margin of 5% and floating rate periodic adjustment cap of 1%, and if the floating rate index changes from 3% on one floating rate adjustment date to 4.5% on the next one, the interest rate will change from 8% to 9%, not 9.5%, because the interest rate can only change by a maximum of 1% per period. The final provision to understand for hybrid fixed-to-ARM DSCR loans is the maximal initial adjustment cap, meaning the maximum the interest rate can change in the specific date when the loan changes from the fixed rate period to the floating rate period. This occurs only one time during the term of the loan. Typically, it is also set to 1% for DSCR loans with the hybrid fixed-to-ARM structure. The intention behind this cap is to prevent initial rate spikes that catch borrowers off guard when the fixed rate period ends. There are a lot of terms and concepts to understand when it comes to DSCR loans with the hybrid fixed-to-ARM structure. However, getting a rock-solid understanding before committing to this option is worthwhile. Additionally, while there are a lot of concepts to remember and numbers to crunch, it all falls under the same theme of making these loans less risky and volatile. For sophisticated borrowers determined to get the best rates and terms possible for all of their rental property deals, it's absolutely worth comparing how a hybrid fixed-to-ARM DSCR loan option looks compared to fixed-rate alternatives. It's always smart to run the numbers when it comes to real estate investing. Plain and simple. Here's another commonly asked question on this topic. Are DSCR loan interest rates fixed or adjustable? The vast majority of DSCR loans are fixed rate for 30-year terms. However, a small portion, likely around 10%, have the hybrid fixed-to-ARM structure, which combines fixed and floating rate periods. No DSCR loans are purely floating rate for the entire term. And there you have it, the complete guide to DSCR loan rate structures. While they are an amazing tool, every real estate journey has its own hurdles. If you want to learn how to navigate them like a pro, head over to harpooncapital.com and fill out our Contact Us form. When you do, we'll send you our completely free ebook, 10 Obstacles for DSCR Loans and How to Overcome Them. Lastly, don't forget to like this video, subscribe to the channel, and check the description for all the links we mentioned today. Happy investing, and we'll see you in the next video.